Is your portfolio hedged? It's a question we have to ask ourselves here at this juncture as the risk off trade seems to be taking a little bit more of a firmer grip on investors. Let's take a look at what's going on more broadly. Taking a step back, I always find this most helpful. Just let's start off with the S&P 500, and what we'll notice here is that as of the time I'm recording this, despite the carnage that is being talked about out there in the media, from an index level perspective, and of course underneath the surface, some things are down way more, things that have gotten pumped up in this gambling bubble we live in. But if you look at the S&P 500, we're just now back to a very crucial level that we have publicly made a really big deal about. You go back and look at our YouTube channel and look at how we talked about 580 on the SPY ETF being a very important point. That was the low after the December Fed meeting, following the December Fed meeting, and then of course the low that held in early January, in March, January 13th. And here, of course, in March, we are once again at that point. Now, it really is hard to know. I think the path of least resistance is lower, but it's the year of the trader, and we have a lot of headlines that could come out, and this market could bounce, right? The question really is, is your portfolio hedged? Because a lot of people don't get nervous until their portfolio is down, 15, at least 10, but really more like 15 to 20%. And if it stays down for about 6 months, that's the key. It's got to stay down because everyone's gotten used to these V-shaped reversals, which when they stop, it's going to be an absolute nightmare for particularly a lot of people that are retired, that have been gambling in the market with Max 7 stocks, and that have done very well, I should say, right? So this is, don't mean it in a derogatory way. I think they've done very well. But the unwind is typically where they give back most of those gains. And so we don't want that to happen to our portfolio. So I think being hedged here is a reasonable thing. It's always good to be hedged, right? But, there's simple ways of doing that: at the money puts, at the money put options, not ones that expire tomorrow or today or next week. Like, let's use ones that expire maybe a quarter or two out and then roll them, right? Like, it's a hedge, it's not a gamble, right? So we need to be a bit more reasonable there. So, if you take this into consideration, you look at bond spreads. I mean, high yield bonds yields, it came off a little bit on Monday. It's really not a big move. Relatively speaking, we're seeing it looks worse, but it's not like credit spreads are blowing out. And then, of course, the VIX has now moved into the low 20s, and I think we need to see, the way we look at the VIX is essentially three sort of tiers. We've talked about this many times before, but if you look at the lower tier there, that's sort of your VIX, essentially, let's say 17 and below, and sometimes it changes a little bit, sometimes it's 15 and below, but let's say 17 and below, and then between 17 and let's call it 24, which is where we still are. As of the time I'm recording this, we're still within this choppy phase where, yes, markets might go down, but they might bounce again. It's really not until we get, I think, pretty firmly above 25, maybe even above 30, where we start to see real risk off. And we're just not there yet, right? It's a great time to hedge, no doubt about it. I think if one is, we've been talking about it for several quarters, if one is only in Max 7 stocks or one is long the S&P, then by the way, you way overweight Max 7 stocks. That's a consideration to maybe start hedging and clipping some of those. Not a recommendation, remember, it's just purely educational what we do here in these videos. But that's one way of hedging. Another way is raise cash. Another way would be just literally be outright and buy, put spreads or something like that, or short futures. So again, in the grand scheme of things, we're really just getting to the lower end of the trading range. But I do think for the S&P, this is the actual S&P 500. I do think it would really not be difficult to get down to 5,700. I would not be surprised if things get gnarly that we get to 5,000. I think that is entirely possible. I don't see a single analyst out there on the street calling for that because they typically are not bearish. They have to be bullish. That's the nature of Wall Street. But it's something that I want to be open-minded to, but I also want to be open-minded to us bouncing here, right? So hedged here is kind of being hedged, I think, is the name of the game.